that with what we're facing right now, we had 2 wars that went on credit cards. We had a housing collapse, which really embroiled us into, as you pointed out, housing being the last leg maybe of this recovery moving forward. So you really can't compare the two and say that the same solutions would have worked for this recovery. And then the other question I might ask you is, would you say that 2007 is a fair starting point for talking about where the recovery started on this chart?
No, December 2007 is the beginning of the recession. The recovery began, according to the NBER, in June of 2009. But you know, I think this has been a unique experience, this last crisis. We've never had a housing boom and bust and such a impact on the financial system as this particular example. The financial crisis was extraordinarily severe. We did come very close to a total global meltdown. And while people can disagree about how much that's held back the recovery, I'm sure that tight credit and mortgages and small businesses and some other areas has been part of that. And I think the monetary policy issue is an important one. I mean, mortgage rates in early 80s were 18% or something like that. And letting interest rates come down as the Fed lightened up, as inflation came down, was certainly part of why the economy bounced back as quickly as it did. And housing was one of the areas that bounced back. So you know, obviously there's some comparability of all recessions, but there's some important differences as well.
Thank you, Mr. Chairman. Mr. Chairman, in my remaining time, I'd like to kind of go back to some of the discussion that we've had about our interaction with the economies on an international market. And we're facing some decisions, and I believe that we need a balanced package of revenue, spending cuts, and that as a robust discussion about how we move forward. But there's many in Congress, some of my colleagues who want to, you know, implement deep cuts. Going back to some of the discussions that you were having with Mr. Tonko, I had an interesting meeting with Ford Motor Company a couple of years ago, and they said, you know, if we had an energy plan that would allow Ford to determine to go gangbusters, whether it's going to be electric, whether it's going to be biofuels, whatever, if we have an energy policy that countries like Japan have an energy policy, the EU came out deciding to go diesel, that would really help our business sector be part of global competition in the way forward with competitiveness. Can you maybe talk about energy policy and a determinants for our country to really embrace one, to allow our businesses to kind of move forward together? Ford really said when they knew that they had to build diesel, they could build the best diesel car. They were totally competitive in Europe. But the lack of us having an energy policy for a nation as large as ours really left them up in the air.
Well, I think companies would like to have clarity about what energy sources are going to be used, how the government is going to tax or subsidize different types of energy. I think the main issues there, frankly, are environmental as much as anything else. You know, Japan, for example, has decided to phase out its nuclear power because of the safety concerns. The EU decision on diesel, I think, was generated primarily by environmental issues. So those are the kinds of issues that's an area where government, you know, may make some decisions about energy policy because certain types of energy, it may be judged are better for the environment. Putting that aside, you know, we do need to maintain a role for energy markets, as we were talking about this before. There's a remarkable increase in the supply of natural gas, for example, in the United States, and that's a good thing as long as we can manage it in a safe and environmental sound way.
Thank you. Mr. Mulvaney.
Thank you, Mr. Chairman. Dr. Bernanke, I want to drill down a little bit on something you've talked about in general here today, which is Europe, and I want to go into some detail on the central bank liquidity swaps, what some folks call the dollar swap agreements. Since you've been here last time, I think it's grown from the agreements with with various central banks have grown from roughly $2.8 billion to about $103 billion as of last week. And my first question is, where does that money come from? Is that money that you have existing reserves? Is that new money? Where does that $103 billion come from that we participate in those agreements?
It becomes both a liability and an asset on the Federal Reserve's balance sheet. I mean, it's some sense paid for by greater excess reserves in the banking system, and on the other side, we have an asset, which is the money given to the, in exchange to the European Central Bank.
But to the extent it's greater excess reserves, that would be, in layman's terms, new money. It's not money that you took out of a maturing treasury and then moved over to a swap agreement. This is money that you set aside for this.
We chose to do it that way because monetary policy currently is obviously has rates very close to zero, but it would not be difficult to sterilize that through a number of different methods.
Fair enough. You stated earlier that it's your current intention with all of your maturing securities to reinvest those. As these securities mature, I think 90% of them are less than 90 days, or actually all of them are less than 90 days. Is your intention to reinvest those in domestic securities, reinvest them in the swap agreements? What's your current intention?
Well, the demand, it's the ECB and the Bank of Japan, the two main counterparties who would determine, what their request is, and then we would decide whether or not to grant the request. So it's not our choice. We're not looking to invest there. If the swaps run out, then that will just be extinguished. It'll mean a comparable drop in our liabilities and our assets.
Fair enough. But to the extent part of this $103 billion goes over to Europe in the swap agreements, comes back within the term of the agreements, and are reinvested in domestic securities, does that have an expansionary effect on the domestic monetary supply?
It does increase the high-powered money supply a little bit. In this case, it would be about 4%, 3-4%. It does not, in practice, have much effect on money in circulation. Only the amount of excess reserves that the banks are holding with the Fed. So we don't, and it doesn't affect interest rates. So what we see it as doing is reducing financial stress, strengthening the role of the dollar in international markets, improving funding for both U.S. and foreign banks. We don't see it as having any major implications for inflation, for example.
How is that different, what you've just described, from what you were trying to accomplish with QE1 and QE2?
Well, the difference being that with QE1 and QE2, we were first of all, they were much bigger. Secondly, we were buying medium to long-term securities on the open market. In this case, the money is going via the ECB, who are our counterparty and take all the risks, are going to help finance the dollar assets of European banks, which is then put back basically in the ECB's.
No, I understand the first half of the transaction, but when the money comes back from Europe and you reinvest it, how is that different from QE1 and QE2?
There's no change. This doesn't involve any change in our holdings of securities. We have an asset, which is the obligation of the ECB, and we have a liability, which is increase in excess reserves. Unless banks are lending those reserves out, it's not going to be turning into more money supply.
You've got the option, as you exercised in 2008, to lend this money directly to the European banks. You could do it to domestic subsidiaries of European banks. Why aren't you doing that? Why are you using the swap agreements instead of lending directly to domestic subsidiaries of overseas banks?
Well, if there was, if domestic subsidiaries of overseas banks came to the discount window, by law, we have to treat them on an even playing field with U.S.-only banks. We do not have any lending right now to the discount window. From our perspective and an economic perspective, and from the U.S. taxpayer's perspective, doing it through a swap is much better because it's the responsibility of the ECB to take the collateral, to decide on where to make, who can qualify for the loan, to decide how much is needed to address the money market problems and so on. And we're totally protected that way. Now, we're protected also in discount window through collateral, but I think this is a better way to do it.
Lastly, and very quickly, we've established, I think you've got the ability to lend directly to domestic subsidiaries. You have the ability to do these swaps. But you told my colleague from South Carolina in December that you had neither the intention nor the authority to bail out European banks. Is that still You still stand by that statement? You do not have the intention or the authority to do that?
So in that particular conversation, off-the-record conversation, I was asked, and I said, well, first of all, let me be clear, we've done these swaps, and I've explained them to them, talked about them. So I wasn't, and they had been done well before that conversation. And then the question was, were we going to do additional things? Were we going to make loans to the IMF or something like that? And the answer is no.
Thank you, sir.
Ms. Washburn-Schultz.
Thank you, Mr. Chairman. Chairman Bernanke, it's good to see you. Our friends on the other side of the aisle, since the debate over the Recovery Act ensued, have furiously tried to insist that it had no impact, that it created no jobs, and that it wasn't necessary. According to CBO, the Recovery Act lowered the unemployment rate by up to 1.8 percentage points in calendar year 2010, up to 1.4 percentage points in 2011, relative to what it would have been had Congress not acted at all. Since that time, actually since 2005, we've created more jobs in last year than we have since 2005, and since March of 2010, 3.2 million jobs have been created in the private sector. So my question to you is, had we not acted and passed the Recovery Act, would that recovery happened as soon or even at all? And are there times, because Mr. Flores seemed to be pressing the notion that it is only private market investment that we should use to help an economy or a recession turn around, are there times when you think public investment like the Recovery Act is necessary?
Well, to answer your question directly, as you say, the CBO calculated some effects on GDP and employment. Obviously, that requires some assumptions about the counterfactual, what would have happened otherwise, but the Fed is, in our analysis, in our modeling, we're basically pretty comfortable with the CBO's conclusions. We think it did have some positive effects on growth and employment. So yes.
Thank you. Then just shifting gears, there's also been a pretty raging debate over the course of the last year over what is the best way to reduce the deficit. Clearly, we all share the goal of reducing the deficit as significantly and as quickly as possible. Would you agree, though, because our friends on the other side of the aisle believe and have tried to enact only spending cuts that they deem wasteful as a strategy towards deficit reduction? Would you agree that wasteful spending also exists and is created in the tax code?
Well, I think you're pushing me into areas which are the province of Congress. I think what the law that I would support is the law of arithmetic. So if you believe that the government should be doing more and spending more, then you should be willing to collect the taxes to do that. And if you want to cut taxes and keep revenues low, then you have to find the spending cuts that match that. So I think that balance is what's critical. People have different visions of what the role of government should play, and I don't think I'm the one to adjudicate that. Clearly, that's a big issue.
No, and I know, and I'm not asking you to make a political judgment because that's our job. But CBO, would you agree with CBO, who has said that tax cuts, like the 2001-2003 tax cuts for the wealthiest, provide the least bang for our buck in terms of job creation and reducing unemployment?
I think that's a debatable point. They provide some demand from the point of view of putting more income in people's pockets. I think the other issue, though, is to ask the question of how do they play into the long-run efficiency of the tax code. I haven't talked about it much today, but I think there would be a lot of benefit without much budgetary cost of thinking about our corporate and personal income tax codes and improving those, reducing reducing inefficient exemptions, broadening the base, and so on. So from a purely demand side perspective, tax cuts do provide income, do provide source of spending. They may be less in some cases than spending in a purely demand side perspective, but you also have to think about the role of the tax code and promoting growth in the long term.
And just one other quick question before my time expires. Would you say